Hi, thanks so much for joining in. You're watching NDTV Profit and my name is Alex Matthew. This is the Mutual Fund Show. And like the name suggests, this show tries to get you actionable insight on everything mutual fund related. Whether it is concepts that will help you invest better or whether it is information that will help you make the right portfolio choices. All of that and more on this program. Now, normally we pick up a certain theme and we focus on that, but my guest today is a veteran of the space and a watcher of the space for a long time. So I thought, why don't I take that opportunity when I'm speaking to him to ask him a variety of topics. And I hope that this is going to benefit you, and do stay tuned for the entire conversation. Joining me today is Dhirendra Kumar, the founder and chief executive officer of Value Research. Dhirendra, thanks as always for taking the time, and always a pleasure having you on the show. Let me start by asking you about recent developments in the space. And I won't get into specific names or anything else because certain investigations are still underway by the market regulator. But what occurred to me at the time is perhaps this is a resurgence of something that we've spoken about in the past. And does that again call for improvements or further improvements to be made in corporate governance? I'm sure you've thought about this as well. Does anything occur to you that mutual funds should be doing that they're not doing right now?
No, I don't think it is on part of the regulator. I think there are enough rules, there are enough regulations, and not only and the regulations are well crafted in terms of detailing things in terms of compliance. All that has to be done, and all that should never be done. But the point is that there is a spirit of the law, and there is a violation there. And marketplace, and particularly the kind of strategy that is at work at the most controversial thing, or the most recent case of Quant. It is something where somebody wants to abuse the information. In case of a mutual fund, it is one can profit from it, and this is a fiduciary responsibility of the fund company to be watchful about it, to be careful about who all the information is shared with. And in that sense, I think this is something which a fund company has to take it very seriously. They cannot really just have that spirit, have the kind of procedure or process of barely complying with things. It should not be, we have seen it in all dimensions of our life. Somebody say that, okay, you have to wear a helmet, and you buy a helmet just so that the cop will not catch you. But if you are faced with an accident, you will be hurt. It's not really de-risking yourself. In that sense, I think fund companies have to really work a little harder in terms as they are getting bigger. The worst, the worst thing that can happen is lack of credibility, lack of trust, or reduction in where I think some stray incident can be very damaging. So fund companies have to really ring fence themselves from these activities and make sure, because I don't think this is a system-wide thing. I don't think there is need for a new regulation. I think it is breach of somebody abusing a set of information, and this is just, there might be a case of fiduciary lapse.
So therefore, okay, one more follow-up to that, and then I want to move to disclosures, because it brings us back. And I remember at the time when this broke, we were once again talking about stress test and possible situations where this would come into play. I do want to ask you about that again, but before that, is there a role then that the various stakeholders play? What does the trustee come and do in such a situation, or what do stakeholders do to prevent such things from happening?
No, you just have to be a little extra cautious, and here is the, you have to devise all the systems and procedures so that this information, first and foremost, the basic principle that everybody who is not supposed to know something should not know it. That is one. Second is that, you have to devise, there are very detailed procedure, which is also audited by SEBI's auditors often, where the dealing function is, one is supposed to conduct in close surrounding. One has to really keep his phones out of that area so that that information cannot be shared with somebody. But that is one part of it. The other is that one has to make sure HR or HR departments of various fund companies need to they need to be watchful about this. They need to have a larger network. Be careful about behavioral things happening at fund companies or in the dealing function or other places, and that's about it. You just need to be a little more careful. Uh, just not have take a view that you have to be compliant with the letter. You have to really be spirited about it.
Okay, so it then comes back to the conversation on stress test, because on the day we were looking at this particular mutual fund and we're talking about its largest schemes, and we're talking about the fact that it had 28 days to liquidate 50% of its portfolio and half of that to liquidate 25%. But then we looked a little deeper, and Dhirendra, this is my analysis. You need to tell me if I'm looking at it wrong. It had 10% in Reliance Industries. It had 5% in Geo Financial Services. It had about 4% of cash. And we're talking about very close to 25% of its portfolio, which would possibly, if required, have been liquidable in a day or two at the most, considering the kind of quality of these assets. So is it really a fair way to look at whether or not a fund like this can deal with a shock?
No, it is not a matter of, markets are so dynamic. If we actually come across a very damning situation and a fund company has to liquidate the liquid part of its portfolio, and the remaining part, if the fund is a dominant holder of that, then, you might be able to overcome the liquidity crisis, but you will end up with a junk. And that is a risk which most equity funds face when they face an exodus in bad times. I know of many funds, many equity funds, where the fund managers have, where they were unable to meet investors' expectation, and they were faced with a situation of redemption running for many years. And when that happens, the fund manager is actually not a fund manager; he is just a redemption manager. And what typically happens is, you just redeem what is sellable. You are faced with the redemption pressure, and you sell what is sellable, and then you end up with a portfolio where you lack the maneuverability. You can't make changes, you can't perform. So I would say that the normal running of a fund is impaired, and this thing changes with your scale. If you're running a 500 crore fund, it's different. When you're running a 10,000 crore fund, it's different, and when you're running a 50,000 crore, you have to it will be of a completely different order.
Fair point. Just to follow up on that then, and in broadly on disclosures, because there's a lot of information, Dhirendra, that is shared by the mutual fund industry on an ongoing basis, whether it is your fact sheets on a monthly basis, whether it's your portfolio statement, whether it is now the stress test. I don't know many investors, Dhirendra, that go into the fine print to the extent that perhaps they could. Simply because you don't have the time required to do all of that, right? Ultimately, there's an element of trust involved. Is there a need to simplify some of these disclosures, do you think, or do we have enough?
No, the point of disclosure is not that every investor will be able to decode all that is being disclosed. It is meant for people like us and many other people, the media, to absorb it, to make sense of it, and distill things in a usable, decodable fashion for investors to, and alarm them if they need to be alarmed, comfort them if they need to be comforted, or just pacify them if they are unnecessarily getting alarmed with something. Bring objectivity based on facts, and this is where I feel that there is enough disclosure. I think investors need to really make sense of it. In fact, if you look at the scale of disclosure, to be able to make sense of it, one needs reasonable resources to absorb it and decode and make sense of it in a timely fashion.
I was reading a piece that you'd written recently, and you were talking about the incident that took place on counting day last month, where a lot of people tried to buy the dip in the equity market, and perhaps a lot of people managed to succeed. However, there were a lot of people that failed to do so, particularly mutual fund investors.
Yeah.
And that's because they didn't get the NAV of the same day. They didn't get the values of the same day for various reasons. And ultimately, we've talked about the RTAs and the reason why this didn't take place. But then, can you really buy the dip as a mutual fund investor, Dhirendra? Is this possible to do?
Yeah, it is possible to do. But, the problem of the dip is that buying the dip is not about, your ability to do it. The real point is that when you attempt to buy the dip, it is an act of courage, because when it dips, you are not sure that will it dip further. Will it dip more again tomorrow? You have the regret. So it is, if you actually buy the dip and it turns out to be a profitable deal, then I think one needs to really appreciate and acknowledge that, okay, you took a chance, you took a bet. But the point is that you can buy the dip, which means that you must have the liquidity. You should, and in mutual funds you can, but and mutual fund is a very, I would say that it is it's a moderated way of buying the dip. If you try to buy the dip with a couple of stocks or just a stock, it could be very, it could be very risky. At least you are buying a diversified portfolio. But, that should not be a strategy. It should be a very once in a while affair, because, all of us have this instinct of trying to profit from a special situation. So you should do it for fun's sake, but not, I don't think, that nothing beats a regular investment plan where you earn every month, or you earn at a periodicity, you spend money and then you save it and then you put it to work in a methodical way. And that is what has worked well for most ordinary investors over a long period of time in a fairly predictable fashion.
To that end, Dhirendra, there are people that invest primarily in the mutual fund space, but they still keep a certain amount of cash available for tactical allocations. Is that something that you think is an appropriate strategy for such events?
Yeah, if you are confident of yourself, if you have seen at least one or two market cycles, you understand that market will go up and this looks like weird, that it has crumbled. You are faced with a March 2020, the pre-COVID thing, or you are faced with January 2008 situation, and you have the courage to dive into it. You can still have the confidence of betting on that. Then by all means, but make sure that it is not your full game. That is 5%, 10%, 15%, because there is other side of a severe, a steep decline in the market in a brief period of time. One is that you might feel happy that, okay, you have 15, 20% liquidity, that you can bet on that. But the point is that 80% of your money will still be invested and that will also be crumbling. And how do you withstand that?
That's a fair point. We're talking at a time when SIP contribution on a monthly basis, at least the gross value, Dhirendra, has crossed that 20,000 crore mark. As I understand it, the net inflows are about half or 40% of that. And I'm told by the industry or participants of the industry that that's par for the course. First of all, is it really the net amount being about 50% of the gross every month? Is that something that you witnessed over a period of time?
Oh, it's a very normal thing, very natural thing, because whatever we might say that, in mutual fund is a long-term, saving investment vehicle, there are investors who need money, and there are investors who think that if they are sitting on profit, they need to really realize it to be able to, book a part of it so that the money comes to their bank in their hand and they feel more comfortable. Also, let's not forget that, if you look at the amount of activity going on, you have these new fund offers which are being sold like a story, and people are buying into it. People are buying into it simply because that is where they're moving the money around. It is not necessarily the net that you see, the money get recycled in some other fund. I don't think the money is really walking away from the industry.
Dhirendra, we were speaking about systematic investment plans, and boy, what kind of flows are we seeing? It's incredible. Having said that, there are some theories that are being propounded, particularly, based on the event that we spoke about last month, which is buying the dip. People are saying that if they had only, timed their investment for that particular day, then they would have benefited. If they split their investments over a 3-day period in the month, say the 5th, the 15th, and the 25th, and they structure their SIPs accordingly, then that's the way to go. Does it really make sense in the long term?
It doesn't make any sense in the long term. In value research, we have done all the quantitative thing. What works in the long term is that you should be investing your long-term money into equity. You should be investing over a period of time. And what works always is that if you are able to, first you should save, then you should invest, and make sure that you are increasing your investment with your rising income, you are able to save more with your rising income. Because most of the time we are thinking in terms of constant, and if you keep doing it, it doesn't really matter. If you look at any 10-year, 15-year, 20-year period and the SIP return, and if you would have succeeded in picking the best day of the month, it really won't make a huge difference. Because what happens is a significant part of your accumulation remains invested, and it actually many a times people come to me to get that secret of finding that great investment and all that. It really doesn't matter over such a long period of time. You end up being a winner anyway.
The other thing that I wanted to talk to you about, and moving beyond SIPs to thematic and sectoral funds, and I've spoken to you about this in the past. I've looked at what you've said over the years. It's become the second largest category in the actively managed equity space last month. There are still people flocking to it. Why do you think that is?
People, there are people who like stories, there are people who like theories, there are people who like conspiracy theories, and mutual fund is a consumer product as well, besides being a savings and investment product. So if you have a person who is being told that, oh, this is a great story going on, and this will pan out, and it will be profitable, and it'll do wonders for you. And here is something which connects with people, the savers and investors. If they can come across, if they are being told a story which will work out nicely or better, it's very difficult to resist that, and that is why you find takers. And most of the time, these themes and sectors which are being sold aggressively are the ones which have done very well in recent past. So investors' favorite pastime is chasing recent past performance. And that is why they turn out to be third. And the reason they have done very well in the recent past is the reason they do very poorly soon after investors have flocked to it. So remember your infrastructure investments at the peak. Remember the technology funds. Remember all the big themes. And so if you are a short-term, medium-term investor, if you have some target in mind, do that. But many a times, there are large number of new investors coming to mutual fund. They're getting attracted to these stories, and that is why they're investing.
The other thing that I want to check with you on sectoral and thematic funds is an argument is made now. While sectors or sector funds are highly concentrated, so if you take, for example, a banking fund, or if you take a pharma fund, or you take an FMCG fund, then that's one way to look at it. But if you look at thematic funds, and particularly the ones that are being launched now, they're broader than the sectoral funds in that, for example, a consumption fund would have multiple companies beyond just the FMCG basket, whereas a BFSI fund would have banks as well as insurance companies, brokers, and certain other companies as well in the financial space. And similarly, you have a manufacturing fund, you have certain other categories. So themes are broader and so don't have the concentration risk. Is that fair?
No, not really. The biggest risk is that they are the hot sector. And, a sector fund, a thematic fund is launched only when the fund company realizes that, okay, there'll be takers, people will fall for it, people will get attracted to it. The story makes sense in the short run, or it'll strike a chord with investors today. And that is the point why one should not, because you need to really tide over a long market cycle. And particularly on these occasions, when it is easy to sell, is generally the bad time to invest, or it is not necessarily a great time to, make a large investment in such a thing. So don't buy based. The biggest free lunch available to investors is diversification, and don't compromise on that. And that is exactly what you do when you go for a sector or a thematic fund.
There are some interesting questions that have been sent to us, and I'm not going to ask you to comment on specific schemes. And I think you've kind of answered the first one, which is Ashish Kar, who's asking about whether there are or which are the best banking funds to invest in. So an argument again that has been made, Dhirendra, is that at what 30+% of the Nifty 50, and with the kind of significant stocks that are currently listed in various actively managed schemes, you will anyway have access to investments into banking. Is that okay? Is that a fair understanding?
Absolutely. If you invest in any multi-cap fund, any flexi-cap fund, 30% of your money is invested in banking stocks or BFSI stocks to the tune of 35%. So I really wonder, but investors get attracted to it's much easier to sell a story. Investors like the high octane charm of a sector fund. If you remember the pharma fund or the FMCG fund, most investors latch onto it after they have done well. And there might be a case for some sectors, which is otherwise not generally available to investors through their mainstream fund, through their diversified vehicles. But I just don't see the case for a banking fund, simply because it has such a large weight in our mainstream index and in all our funds.
Yeah. The second question, incidentally, you mentioned multi-cap and flexi-cap funds, and Purvesh, who is 40 years old, is asking what the difference is and how do I choose between the two. Dhirendra, you want to explain it to him?
Yeah, I would like to explain that. Flexi Cap has all the flexibility to the fund manager. He can invest in large, mid, and small uh, in a manner he likes. If he likes large caps more today, he can invest in large caps or mid caps or small caps, depending on. So he has absolute flexibility. In multi caps, there is a ceiling. There's a minimum. There's a floor to each allocation, and the allocation is defined by the regulator. The large cap is defined as the top 100 companies. Next 150 companies are mid caps, and the rest are small caps. And minimum 25% is mandated to be invested in the three, in a multi-cap fund. 25% must be in large, mid, and small. And the fund manager has the flexibility of allocating his money for the remaining 25%. So this forced diversification across allocation, across capitalization, has turned out to be very important and rewarding as well. So if you have to choose between two, choose multi-cap, simply because flexi caps have turned out to be large cap funds, simply because they have turned big.
Very interesting. And incidentally, a few of these schemes, a few of these fund houses which had initially gone the flexi cap way when the split did happen are now launching multi caps, and that's quite interesting as well. Another question coming in from Lalita Thapar, and this is an interesting one. 24 years old. She's saying she invests 20,000 rupees per month on 7 funds, and she's not specified which they are, Dhirendra, but she's saying most of the allocation is going into mid cap and small cap. Should she add more exposure to large caps? And she's got a long-term investment horizon, which I think this is an interesting question, because we're hearing from fund managers themselves and we're hearing from various advisors that perhaps now is a good time to correct imbalances in your portfolio, and things that have done very well over the last year may not do so. So should she reallocate?
No, it entirely depends, because if you are investing for next 20 years, don't bother. You will have bad times, you will have good times, and if you look at the return, 20-year return or 15-year return of the large cap category, I'm talking of category, which would be made up of all the good and lousy funds as well. It turns out to be twice as much, or 1.5 times more than the large cap funds. So I would say that it will be prudent to add some large cap if your portfolio is entirely made up of mid and small cap, and if not 50-70%, at least 25%. Consider that. And maybe you don't need to buy an actively managed fund. Just pick a lowest cost index fund, and that'll do the job.
Quick.
So that is what I would suggest. But if you are still investing for next 10 years, 15 years, don't bother.
Quick follow-up. We have just a few more seconds, Dhirendra, but Nifty 50 or a broader gauge, would you say the Nifty 100 is better?
Nifty 50, Nifty 100, doesn't matter.
Okay.
If you, because what will do well over the next 5 year, 10 year, I don't know. But I'm hopeful that, and the difference between the two will not be very significant.
Okay, fair point. Dhirendra, thank you so much for taking the time. Always a pleasure having you on the show.
My pleasure.
All right, viewers, that brings us to the end of this edition of the Mutual Fund Show. Let us know what you think. Can you see that number on your screen? You can send your queries to us there, and we'll take that up in the coming episodes. Do stay tuned. Lots more coming up on NDTV Profit.